Imagine standing in front of your dream business, a cozy cafe, a buzzing online store, or maybe your own tech startup. You can see it clearly. But there's one problem. You have the idea, the passion, even the plan, but not the money. That's where business startup loans come in. And today, you're going to learn exactly how to get one, even if you're starting from scratch. By the end of this video, you'll know how lenders think, what they look for, and how to increase your chances of getting approved. But here's the twist. Most people who apply for startup loans fail. Why? Because they make the same simple mistakes over and over again. Stick around, because in a few minutes, I'll reveal those mistakes and how you can avoid them. Number 1. Understanding what a business startup loan really is. Before you rush to apply, let's start with the basics. A business startup loan is money borrowed to start or grow a new business. You borrow a certain amount, agree to repay it with interest, and use it to fund your startup costs, like equipment, marketing, or working capital. Think of it as borrowing from your future success. The loan helps you get started today, so your business can generate the income to pay it back later. For example, let's say Sarah wants to open a small bakery. She needs $50,000 for ovens, ingredients, and shop rent. Instead of saving for years, she gets a business startup loan, opens her bakery within months, and starts earning money right away. That's the power of using a loan wisely. It can help your dream move faster. Number 2. Why lenders are hesitant with startups. Now, let's be honest. Lenders love businesses with proven success. But startups? They're risky. Why? Because there's no track record. You don't yet have sales data, customer reviews, or a steady cash flow to prove you can repay the loan. It's like lending your car to someone who just got their driver's license. You're a little nervous, right? That's exactly how banks feel about brand new businesses. So instead of just applying blindly, you need to show them evidence that your business can succeed, even before it fully starts. And that begins with the next step. Number 3. Create a strong business plan that lenders can trust. This is your secret weapon. A business plan isn't just a fancy document. It's your proof that you know what you're doing. Lenders want to see that you've researched your market, understand your competition, and have a clear plan for making money. Your business plan should answer key questions like, what problem does your business solve? Who are your customers? How will you make money? What will you spend the loan on? And, most importantly, how will you pay it back? Let's use an example. John wants a loan to start a landscaping business. In his business plan, he includes a list of potential clients, seasonal pricing plans, and even photos of properties he could work on. This kind of detail makes a lender think, okay, this person has done their homework. If your plan looks confident, clear, and data-backed, lenders are far more likely to say yes. Number 4. Know the different types of startup loans. Not all startup loans are the same. Let's go through a few options you can explore. Traditional bank loans are the most common. These usually require good credit, a solid business plan, and sometimes collateral, like your car or house. Then there are SBA loans, backed by the Small Business Administration. These are popular because the government guarantees a portion of the loan, making it less risky for lenders. SBA loans are great for startups that need larger amounts and have a well-prepared plan. You can also look at microloans. These are smaller loans, often between $5,000 to $50,000, designed for small businesses and beginners. Another option is business credit cards or lines of credit, which work like flexible cash sources for short-term expenses. And finally, there's crowdfunding and peer-to-peer lending, where regular people or investors fund your idea online. Each option has pros and cons, but what matters most is choosing the one that fits your business size, timeline, and financial situation. Number 5. Check your personal and business credit. Here's something most beginners miss. Even if your business is new, lenders will still look at your personal credit score. Because your business doesn't have a history yet, they want to see if you are financially responsible. So before you apply, check your credit report. If your score is below 650, start improving it. Pay down debts, make all payments on time, and avoid new credit inquiries. Think of your credit score as your trust score. The higher it is, the more lenders trust you. Once your business starts growing, open a business bank account and get a business credit card to start building a separate business credit history. Over time, this helps you qualify for larger loans with better terms. Number 6. Gather the right documents before applying. This part might sound boring, but it's crucial. Most loan applications fail because the applicant doesn't have their paperwork ready. Lenders usually ask for a detailed business plan, personal and business tax returns, bank statements, financial projections, legal documents like licenses or registration. If you're not ready with these, you'll delay the process. Or worse, look unprofessional. Imagine two people applying for a loan. One walks in with a neat folder containing every required document. The other says, I think I can email that later. Who do you think gets approved? Exactly. Preparation shows credibility, and credibility builds lender confidence. Number 7. Determine how much money you actually need. This one's big. Many beginners either ask for too little or way too much. Asking for too little means you'll run out of funds halfway through your business launch. Asking for too much makes lenders doubt your financial judgment. The trick? Calculate your startup costs carefully. Let's say you're opening a coffee shop. Add up rent, renovations, equipment, inventory, licenses, and marketing costs. Then add a few months of operating expenses until you start making profits. Maybe that totals $80,000. That's your realistic number. Knowing your exact funding needs makes you look professional and confident, qualities lenders love to see. Number 8. Explore alternative funding sources. Startup loans aren't your only option. If banks turn you down, don't panic. There are creative ways to raise funds. You can apply for government grants or local business development programs. Some communities offer grants to women-owned, minority-owned, or veteran-owned startups. You can also pitch to angel investors, individuals who fund early-stage businesses in exchange for a share of ownership. Another path is crowdfunding. Platforms like Kickstarter or GoFundMe let you raise small contributions from hundreds of supporters who believe in your idea. And if you have friends or family who want to invest, make sure to document everything with a written agreement. It keeps things clear and avoids misunderstandings later. Many successful businesses, like Oculus, Pebble, and even some restaurants, started this way before becoming major players. Number 9. Be ready to offer collateral or a personal guarantee. Lenders want to minimize their risk, so they might ask for collateral, an asset like property, equipment, or savings that they can take if you don't repay. Or they may ask you to sign a personal guarantee, meaning you're personally responsible for paying the loan if your business fails. It might sound intimidating, but it's common practice. If you believe in your idea and manage your business smartly, that risk becomes motivation to make it work no matter what. For example, a man named Alex used his car as collateral for a $20,000 startup loan to begin his mobile repair business. Within a year, he tripled his investment and paid off the loan early. Calculated risk, smart reward. Number 10. Present yourself professionally. When you apply for a loan, you're not just presenting your business, you're selling yourself. Dress well. Speak confidently. Know your numbers. When a lender asks, "How will you use this money?" you should have a clear, detailed answer. If you can't explain your plan in simple terms, it shows you might not understand your own business yet. Think of it like a job interview, because it is. You're interviewing for money, and the more confident and professional you appear, the better your chances. Number 11. Avoid these common mistakes. Let's talk about what not to do. Mistake 1. Applying for multiple loans at once. This can hurt your credit score and make lenders think you're desperate. Mistake 2. Not understanding loan terms. Always read the fine print, interest rate, repayment schedule, and penalties. Mistake 3. Not having a repayment plan. Lenders want to see exactly how you'll make enough to pay them back. Mistake 4. Overestimating revenue. Be realistic. If your projections look like a fantasy, lenders will see right through it. Avoid these, and you're already ahead of most applicants. Number 12. How to improve your chances of approval. Want to stand out? Here's how. Build relationships with local banks before you apply. Open a business checking account and maintain regular deposits. Get small vendor credit lines, like from suppliers, and pay them on time. Network with local business advisors or chambers of commerce. Sometimes, a personal recommendation can make all the difference. And finally, start small. If you get approved for a small loan and repay it on time, it builds trust. Then, when you need a bigger one, lenders already know you're reliable. Number 13. What happens after you get approved? Congratulations! The hard part's done, but now the real work begins. Once you receive your loan, use the money exactly as planned. Don't splurge or mix it with personal expenses. Track every dollar. Keep receipts and financial records organized. Why? Because if your business grows and you want another loan later, lenders will check how you manage the first one. Good record keeping and responsible spending make future approvals faster and easier. Number 14. What if you get rejected? Rejection doesn't mean failure. It's feedback. If your loan application gets denied, ask the lender why. Maybe your credit score was too low. Maybe your business plan wasn't detailed enough. Or maybe you just needed more time in business. Take those notes seriously. Improve them. Then try again. Many successful entrepreneurs were rejected several times before getting funded. Walt Disney, Henry Ford, even Colonel Sanders faced countless rejections before building their empires. So don't quit, just adjust your approach. Number 15. Understand interest rates and loan terms clearly. Many beginners make the mistake of focusing only on how much money they can borrow, without looking closely at the cost of borrowing. Every loan has an interest rate and repayment term, which decide how much you will end up paying in total. A shorter loan term usually means higher monthly payments, but lower total interest. A longer term lowers your monthly payments, but increases the total cost over time. For example, borrowing $20,000 for 3 years at 8% interest costs less overall than borrowing the same amount for 5 years at the same rate. Always use a business loan calculator before signing any agreement so you can understand what you are committing to. Number 16. Learn about loan fees and hidden costs. Even if the interest rate looks good, some lenders add extra fees that increase your overall cost. These can include origination fees, processing charges, or early repayment penalties. Imagine thinking you got a great deal, only to realize there was a 2% origination fee that added hundreds of dollars to your cost. Before accepting any loan, ask your lender to explain all fees in writing. Transparency helps you compare options fairly and avoid unexpected surprises. Number 17. Strengthen your financial projections. Lenders love seeing realistic, data-backed financial projections. Your projections should show your expected revenue, expenses, and profits for the next 1 to 3 years. If you can explain how your business will reach those numbers, it builds trust. For example, if you own a food truck, estimate daily sales based on local traffic, food prices, and average customer spend. Add seasonality and potential growth over time. Strong, realistic numbers make lenders feel you understand your business deeply, and that makes them more confident to fund you. Number 18. Know the difference between secured and unsecured loans. A secured loan is backed by collateral, like your property or vehicle. If you fail to repay, the lender can take that asset. An unsecured loan, on the other hand, doesn't require collateral, but usually has a higher interest rate. If you are just starting out and have few assets, unsecured loans may sound attractive, but remember, the interest cost adds up quickly. Always weigh the risks and rewards before deciding which type suits you better. Number 19. Use lender-specific programs for startups. Some banks and online lenders have programs designed specifically for startups. For example, certain banks offer small business loans for new owners who have completed an entrepreneurship course or business accelerator program. Others work with local community organizations to fund first-time founders. These programs may have easier requirements, lower interest rates, or more flexible repayment options. Do some research or visit your local small business center to learn about programs available in your area. You might find options that traditional lenders don't advertise widely. Number 20. Consider co-signing or partnering. If your credit score or experience is holding you back, bringing in a co-signer can help. A co-signer is someone with good credit who agrees to share responsibility for the loan. This reduces the lender's risk and can help you get approved faster. For example, if your uncle has strong credit and believes in your business, he can co-sign your loan application to improve your chances. Just remember, if you fail to pay, your co-signer becomes responsible, so make sure you both fully understand the agreement. Number 21. Take advantage of business incubators and mentorship programs. Sometimes, the best way to get a startup loan is not by applying directly, but by joining a program that helps you prepare. Business incubators, accelerators, and mentorship programs guide you in refining your business model and connecting you to funding networks. They often partner with banks or angel investors who trust their graduates more. For instance, a local entrepreneurship center may train new business owners for 12 weeks and then introduce them to lenders ready to support promising graduates. Joining such programs increases your credibility and sometimes even gives you access to exclusive loan opportunities. Number 22, build cash flow before applying. This might sound strange, but one of the smartest ways to qualify for a loan is to start making money before asking for one. Even small proof of income, like early pre-orders or small contracts, shows lenders that there's real demand for your product. For example, if you want to open a catering business, start with a few local events first. When you show those numbers in your loan application, lenders see that your business is already moving in the right direction. This makes your case much stronger. Number 23, match the loan type to your business goal. Not every loan suits every goal. If you need money for long-term assets like equipment, look for equipment financing loans. If you need short-term working capital, a business line of credit or merchant cash advance might make more sense. Using the right type of loan keeps your repayment manageable and aligned with how your business earns money. For instance, borrowing a 3-year loan for a one-time marketing campaign could hurt your cash flow later. Always choose a loan that matches your goals timeline. Number 24, learn to negotiate loan terms. Many beginners think loan terms are fixed, but in reality, lenders often have room to adjust. If you have multiple offers or a strong credit profile, use that leverage. You can negotiate lower interest, longer repayment time, or reduced fees. For example, if two lenders offer you similar deals, tell one you'd prefer them if they can cut the origination fee in half. They may agree, saving you hundreds or even thousands of dollars. Negotiation is part of business. Don't be afraid to use it. Number 25, time your application right. Timing matters more than most people think. Applying for a loan right after tax season, when your finances are clearly documented, can help. Avoid applying when your credit score just dropped or after taking on new debt. If your business is seasonal, apply right before your busy period to show strong future income potential. Being strategic about timing gives lenders confidence that you are thoughtful and prepared. Number 26, know the power of a loan proposal. While your business plan is important, a loan proposal is a shorter, more targeted document created just for lenders. It includes your loan request amount, how you'll use it, repayment plan, and why your business will succeed. Think of it as your pitch deck for financing. If your proposal is concise and convincing, lenders can quickly understand your purpose and risk level. A clear, one-page loan proposal can sometimes do more for your approval chances than a 50-page business plan. Number 27, keep communication open with your lender. If something goes wrong, like a delay in business income, don't go silent. Lenders appreciate honesty. Contact them early, explain the situation, and propose a plan to stay on track. This builds trust and can help you avoid penalties or negative credit marks. Many lenders prefer working with borrowers who communicate rather than those who disappear. Building a long-term relationship with your lender can even open doors to future funding. Here's the truth. Getting a business startup loan isn't easy, but it's absolutely possible. With preparation, persistence, and smart strategy, you can turn no into approved. Now imagine holding that loan approval letter in your hand. You're not just starting a business, you're starting a new chapter of your life. So here's my question for you. What kind of business would you start if money wasn't the problem? Tell me in the comments. I'd love to hear your dream.